A study by JP Morgan showed that if an investor remained fully invested in the S&P 500 from 1998 to 2018, their annualized return would be 5.62%. However, missing the best 10 days, just 10, during that exact same period would have reduced their annualized return 2.0 to 2.01%. Like, that is crazy to me.
That's insane.
I mean, that's 20 years worth of days.
Yeah.
Like, the market's open probably somewhere around 320 days a year.
Yeah.
I don't know exactly, but maybe you should know that, but it's somewhere around there. And so multiply that by 20.
Yeah.
Is that like over 6,000 days?
Yeah.
Right? So if you have over 6,000 trading days,
Yeah.
and the average is 5.6, just remove 10 of those 6,000 days.
Yeah.
The 10 best. And you go from 5.6% return to 2% return. And here's the crazy part, is best days often happen in high volatility, and wait for it, also during bear markets.
Yeah.
Best days on average, a best day in any given year is typically after a large sell-off happens.
Yeah, like a really bad day.
And then, so imagine how many people panic sell on those bad days or in those down cycles.
Oh, man.
They miss that one best day. And then boom, you just went from 5.5% annualized return over 20 years. Welcome to another episode of Money Therapy. I am your host, Brandon Chastain.
I'm Bill McGill.
And we're excited to talk to you today.
Oh, yeah.
We hope you're going to learn. Like, you should definitely learn something today. We're excited about that. Guys, before we jump in, I really want to talk to you kind of about like the money therapy ecosystem. So most of you know we own and work for Harpeth Wealth Partners. We're a small boutique financial planning firm. And this podcast is a way to educate everybody that I don't have access to that wants to learn. There's a lot of podcasts out there that talk about the actual thing, the step to take to like open an account or how to analyze a stock. When I read books, when I study, when I listen to all these, podcasts, in trying to learn more about my job and becoming a better professional, something that I noticed a gap there was largely the most important piece, and that's the human being, the human experience that's involved in the financial process. Bill would probably agree with me when it comes to managing money. The math and science side is so easy.
Yeah.
Right? Like once you learn what buttons to hit on the calculator, once you learn how to do the stock analysis, once you learn how to build a portfolio and adjust for risk, once you learn how to ask the right questions for time horizons and all these, like the math and science side is very, very simple.
Yeah.
And there's so much information out there about the math and science side.
Yeah.
What's missing is the human being side. So we started Money Therapy just as a way to say, hey, you're never going to do this easy, and you're never going to do it perfectly, and you're especially going to have a tough time if you don't consider yourself, right? So it's been monumentous in our clients' lives, and we wanted to make it available to all of you. And obviously, sitting down one-on-one with us is we hope it's very, very valuable to our clients that have the opportunity to do that. And we invite you to always feel free to reach out to us, because we think that we could be very valuable assets to most people that come across us. But the fact of the matter is, if you're just listening to this and you're truly like reflecting and journaling and trying to make this stuff applicable, you're probably going to do very, very well. So thus Money Therapy. There's a critical part of this kind of journey, where if you're only listening to the podcast, you may not know about it. And that is our email distro that goes out, right? So at a minimum, once a week, and usually at a maximum, about 3 times a week, we send out an email. And the particular one that I'm gonna talk about now is our email that is the Sunday series. So what the Sunday series is it is an email that is basic. It should only take about 2 minutes to read. And it presents the thought that Bill and I are going to discuss on the podcast on Tuesday. So if you're in our email distribution, you get the email Sunday morning, and the email might say something like subject, behavior versus everything else. The fact is our behaviors trump a solid portfolio every time. And then the email, again, pretty short, pretty succinct, but the email is sent to you in a way to make you think about your own thoughts about this topic.
Yeah.
So then on Tuesday, when you listen to the podcast, you get to hear our lovely voices discussing that idea from a very professional standpoint, right? So a lot of you guys might be listening to this podcast and be like, man, this is a lot of information coming really fast. A lot of our people in our ecosystem have already had 2 days to think about how this applies to them and think about their own questions and their own thoughts. So when they hear us talking about it, they get to kind of start to merge, and then hopefully a day or two, they'll journal one more time or think about it one more time. And that really helps commit a lot of this stuff to memory. So I say all that to say, if you want to get on the email distribution, all you got to do is send us an email and say, please add us. It's free. The other stuff that we send out, again, generally 3 to 5 minute reads. We do market summaries. We do just really kind of timely thoughts. So a couple weeks ago, we sent out a great email about kind of the banking disruption that was going on.
Sure.
Well, we've sent out, back to school conversations about, college and family planning. We've sent out all kinds of information. So if you want to be on those email distributions, you just shoot us an email. My email, BM as in Mike, C at harpethwealthpartners.com. And that's HarpethWealthPartners.com. HarpethWealthPartners.com.
Nailed it.
You can also just go to HarpethWealthPartners.com, and there's a contact us page. And almost every show that I put on anything will have my email address and our Harpeth Wealth Partners website in the show notes. So you can always find that there. Bill, what's a good way for them to get in touch with you?
Yeah, my email will be on the website as well, and it's bill.magill. Magill is spelled Magill, at harpethwealthpartners.com.
Okay.
And I think that's definitely the number one way to get plugged into what we're trying to do here, which is, I think community is the huge thing. We're trying to create an ecosystem and a community that supports one another, that basically takes the charge out of personal finance and allows people to be comfortable in asking those questions that they need to be able to succeed. It's one of the reasons why I like the name Money Therapy so much, because so much time early on in our careers, I'm sure your career, but looking back on my own career, so much time was spent trying to explain to people what I did for a living.
Yeah.
And people would, always, hey, what do you do? And I'd say, I'm a financial advisor, or I'm a financial planner. And, financial advisor is usually what I would use. And most people don't know what that is. And after a while, I started using, I'm a financial coach.
Yeah.
I'm kind of like a personal trainer for your finances, or a lot of times I'm almost like a money therapist.
Yep.
Yeah, because I'm sitting there with people, and sometimes the hardest part of their lives, sometimes the best part of their lives, and they're trying to figure out what to do next and where to go. So that's why I like this show so much, because with the emails, with the app that we'll talk about a little bit later, with this podcast, we just try and give you our perspective and just be human about it and say we don't have all the answers all the time, but we try just as much as you guys do to help our fellow man and put you all in a better position than we were last week.
Yeah, and I think like there's so much that we offer, and our clients obviously we offer them a ton of support, a ton of help, a ton of coaching. We do a lot by way of managing their portfolios, but even outside of that, just because we think that this is so important, and we don't have the resources to sit, knee to knee with every single person in our community, we put this resource out there. So one, you can learn. But again, if you have email, send us an email. You'll get the emails. We do webinars. The webinars are free. If you want to connect with us on social media, Brandon Chastain, you can find me on LinkedIn, Facebook, Instagram, or Harpeth Wealth Partners on Facebook and Instagram. But you're more than welcome to just dive in as deep as you want to into this ecosystem, and because it's so connected. I do these stupid stickman drawings that kind of just deliver a simple thought, and a lot of time that simple thought is based on something that I came up with while I'm thinking about the content that we're making for our podcast. My LinkedIn page, I put up LinkedIn articles. Like I said, we do the email distribution. So we're trying to get all the education out there that we possibly can. The webinars are built largely around our app that we use for financial planning, and the app is super incredible. But again, you can get an invitation to that. So just email us, and in the subject, just put, email distribution or money therapy ecosystem. Ask us to add you, and we will. And every email that we ever send comes with an unsubscribe link. So if it gets to be too much, we apologize ahead of time, and you can just unsubscribe. But most of our clients, most of our listeners love it. So we're going to jump in, and I'm actually going to jump ahead. I'm going to rearrange a little thing because I think this is a pretty cool fact. And so here we go. A study by JP Morgan showed that if an investor remained fully invested in the S&P 500 from 1998 to 2018, their annualized return would be 5.62%. However, missing the best 10 days, just 10, during that exact same period would have reduced their annualized return 2.0 to 2.01%. Like, that is crazy to me.
That's insane.
I mean, that's 20 years worth of days.
Yeah.
Like, the market's open probably somewhere around 320 days a year.
Yeah.
I don't know exactly, but maybe you should know that, but it's somewhere around there. And so multiply that by 20.
Yeah.
Is that like over 6,000 days?
Yeah.
Right? So if you have over 6,000 trading days,
Yeah.
and the average is 5.6, just remove 10 of those 6,000 days.
Yeah.
The 10 best. And you go from 5.6% return to 2% return. And here's the crazy part is best days often happen in high volatility and wait for it, also during bear markets.
Yeah.
Best days on average, a best day in any given year is typically after a large sell-off happens.
Yeah, like a really bad day.
Imagine how many people panic sell on those bad days or in those down cycles.
Oh, man.
They miss that one best day. And then boom, you just went from 5.5% annualized return over 20 years. Mm-hmm. And let's talk about that 20 years real quick. From 1998.
Yeah.
Right? .com bubble, 9/11, financial crisis,
2017.
like just the debt crisis thing, the downgrade from the Moody's or whoever downgraded the U.S. debt from AAA to whatever. Like, there has been I mean, well, no, we cut it off. We did cut it off at 2018. So no COVID in that one.
Yeah.
But that's insane. Like all those ups and downs.
Yeah.
And if you would have just stuck it out, 5.5%.
Yeah.
But if you would have been on your own, like a lot of people say they want to do,
Yeah.
and then they let behaviors and emotions get the best of them, and they sell on a bad market day,
Yeah.
and they miss that next day that happens to be one of the top 10 over 20 years, you just cut your return in half.
Yeah.
That's crazy. So, Carl Richards, I mentioned him in the previous episode, his book, Behavior Gap. Highly, highly recommend it. Carl Richards is a phenomenal thinker. I share a lot of his ideas. I really, really like Carl Richards. But one of his quotes is, "The biggest risk you face in investing is not market risk. It's the risk of not sticking with your plan."
Yeah.
So we have a one-page financial plan. At the top of that one-page financial plan it's just your values statement.
Yeah.
And then underneath that, it's your goals.
Yeah.
And then after that, it's those tiny micro steps that
Yeah.
you need to take. So anytime that we start talking about money and you start having emotions creep in, I always point back to those values, because our values are more important than our emotions 10 out of 10 times. But if we don't understand our values, if we don't really know who we are,
Yeah.
we lose clarity, we don't have these things written down, emotions win every time.
Yeah.
Right. So, read another fun fact here. According to a study by Dalbar Inc., don't know who they are, just a study, individual investors significantly underperform the market over the long term. The study found that over a 20-year period, the average investor earned only a fraction of the returns that major indices like the S&P 500 provided.
Yeah.
This study attributes the underperformance to behavioral factors and investor biases. Here's some key reasons. I'll give you a few. We tend to make decisions emotionally, not rationally. And I don't care how,
Shocker.
like, I'm a pretty rational human being. When it comes down to my financial decision making, I get kind of emotional about it.
Yeah.
I hear all the time that I'm not a super emotional person, but I am. And I'm going to be lying. I'd be lying to myself. I was like, oh, I'm super rational. I can do this on my own. Right.
Reminds me of a Vanguard thing. It might have been part of the same study, but Vanguard put out an article, I think, a long time ago about I think it was their Magellan Fund, which has been around for 80 years or something crazy like that. And the average return of that fund, and I could be misquoting Magellan. That's the name that's coming to mind, but it could be wrong. But one of their funds returned over 13% per year annualized return for 80 something plus 90 years. But they found that the average investor who decided to invest in that fund, their return was somewhere around 3%.
Wow.
And people go,
Ugh.
how can that possibly happen? It's like, because they don't stick to the plan.
And we talk about it all the time, right? We talk about these set it and forget it philosophies, invest in the broad market, buy the S&P, hold it for 20 years. But we still sometimes fall short of this idea that people will still make emotional decisions. And even if they sell the S&P, they might come back to it 2 weeks later.
Yeah.
But they sold it and they get back. They sell it when they're scared. They buy it when they're high, or they buy more when it's higher because now it feels good. And they sell the minute it starts to come down. So emotional decision making, like when it comes to finance, guys, like these behaviors, this is real psychology. This is real stuff. And if you Google or go and search some of these emotional behaviors, like financial behaviors, you'll find some things. So I'm going to give you a few examples. And we've talked about a couple of these before. So herd mentality, right? Herd mentality just says that I'm probably going to do what most other people are doing.
Yeah.
So I'm going to, if you are about to make a decision, zoom out, get like a airplane view kind of thing, 10,000 foot view, and look at everyone in your life that matters and the things that they're doing. And there's probably some truth that other people are doing the same thing that you're about to do, whether you're consciously deciding to do that or unconsciously deciding to do that. We've seen this so many times. One example that we can give is like the dot-com bubble. Everybody was like tech, tech, tech.
Tech, tech, tech.
They're buying, and then all of a sudden the bubble pops, and people were pretty mad. And guess what? They were kind of collectively mad together, like it was a herd mentality.
Well, and it goes back. I mean, even there's that psychological study that shows that people would much rather be wrong with everybody else than be right and be by themselves.
Yeah.
So,
I think too, like, I mean, we've seen this more recently, and I'm not here to say anything is right or wrong. But there was a lot of people willing to jump on board with cryptocurrency.
yes.
And I'm not saying that you shouldn't, or you should if it fits and if it's good and it's part of your risk profile. Like, I'm not saying that you shouldn't do that. What I am saying though is people are willing to jump into cryptocurrency without even considering the risk.
Yeah.
Without even considering, like, I don't know a thing about what I'm purchasing.
Right.
They were just like, hey, everybody's making some money. I want some of that too. Right.
Yeah,
So they
right.
jump in. So that's herd mentality. The next, like, this one isn't kind of like the name's not quite as creative, but just, lacking patience or discipline.
Yeah.
Sometimes we just lack patience or discipline. Sometimes my job as that financial professional in front of my client is almost solely to be kind of a lead blocker.
Yeah.
And, like, as a lead blocker, sometimes you're reaching back and grabbing your running back and pulling them along with you.
Yeah.
Right. So sometimes you are the source. I'm the source of the motivation. I'm the source of the discipline. I'm the source of the patience to my clients. And I think that's all super important. And we need to just be self-aware of when we're lacking the motivation, patience to stay in the fight and stay in the game and to do it well. What else we got? Performance chasing. So this often, I think that performance chasing, this is one of the reasons why I love my app that we get to use for financial planning. And I've met so many people that had great portfolios
Right.
that were taking certain amount of risk that they were willing to take. But once we like stepped back and found out their needs, their wants, their goals, their values, their timeline, we could sit there and realize, like, hey, we're taking, an 8 out of 10 on the risk scale.
Yeah.
But we can make all these things work if we even went back to like a 5 out of 10.
Yeah.
So why don't we cut off some of the risk? Now, your returns year over year may be a little less, but you don't need it. You don't need it to have all of this stuff.
Right.
So that goes back to the conversations we had about, like, how much is enough, right?
Yeah.
Once we have those goals and we know how much is enough, maybe we don't need to be riding the crazy train.
Yeah.
So I think sometimes when we see this performance chasing, inevitably, if you expose yourself to the market, you will experience losses. I don't know of anybody that has invested money that doesn't have, or at some point did not have some sort of loss on their portfolio, right? Mm-hmm. But when we have these losses and if we're already feeling behind, we might feel that we have to take even more loss to catch up, or more risk to catch up.
Yeah.
So performance chasing can be just super detrimental. There's a couple. You want to read the Warren Buffett stuff you got?
Yeah, Warren Buffett has got a couple of quotes that I'm sure some people have heard before. My first, he's got kind of a deeper one here, but the first one that always comes to mind with Warren Buffett that I love is be fearful when others are greedy, and greedy when others are fearful.
So the opposite of herd mentality.
The opposite of herd. We call that, sometimes in the business, we call that contrarian. But it's a really good way of kind of what we said earlier, taking that 10,000 foot view and making sure that you're making a decision not based on what everybody else is doing, but what you think is actually a good decision. And sometimes being a contrarian, again, what we call being a contrarian is a great way to do that. And it's something that I use that quote all the time with clients, especially in times like we're in now with, market volatility and all these things. With all of the evidence that we've shown here today, and we could do, 5 months of nothing but evidence episodes on how not selling and just staying in the market's the best way to invest.
Yeah.
I mean, we could do that forever. But it's really good quote to get people to kind of think about their decisions or the decisions that they'd like to make. Usually we're pretty good about talking people out of the bad ones, but
And I think everything that Warren Buffett, Warren Buffett's a really, really smart guy.
yeah,
But so much of what he says boils down to the simple, like sometimes we just overcomplicate this stuff. And like, my football coach used to say, like, Brandon, at the end of the day, this is blocking and tackling,
yeah,
and I think Warren Buffett just in the back of his mind, he can't unthink long-term, diversified, risk appropriate.
yeah,
Right? I mean, if you take any quote that you read
yeah,
and you think, does it fall under the shadow of long-term
yeah,
ideology, risk appropriate ideology, or whatever the other one I said, diversified ideology, like it's always going to hit, right?
yeah.
Another great thought leader in this space is Daniel Kahneman. I hope it's Kahneman. That's how I say it.
Kahneman.
Kahneman. So he does a lot of talk, writing on this cognitive bias space, and so if you want to read more, because like you really need to spend some time, it's research, like it's actually doing some homework, but it's so good for you. A lot of this stuff we break up. We could talk for 3 or 4, maybe even 5 episodes off of anchoring,
Yeah,
right? To really teach and help people understand what it is. But so if you want to do that kind of homework on your own, you can. But and Daniel Kahneman's a great guy to look up. Speaks a lot on that stuff. All right. So here's the thing. I am, wanting to achieve financial independence, and I keep kind of feeling stuck, and I feel like I keep making these stupid mistakes with my money. Even when things are going well, I'll probably mess it up, right? I'm in my head. How do I go about circumventing those things? Like, what are the action steps that I can take? And here's where we're going to do a little self-indulgent. We're going to do some shameless promotion of the Harpeth Wealth side of the business. So first and foremost, like we were just alluding to with Warren Buffett, think long-term, right? If the market is down today, you don't have to sell, because we know the stats, right? If tomorrow happens to be the best day and I miss tomorrow, there's a good chance I'm on my way to a 2% return versus a 5.5% return, right? So if I'm just thinking about the right now of my money, and I'm not thinking about future Brandon's money, then I'm going to react based on the stimulus from right now.
right,
Right. But if I can say, hey, this is long term, I'm playing a different game than what the media is saying. Like we call it financial porn networks. Like if they're like armchair quarterbacking an entirely different game than I'm playing. It just feels the same.
yeah,
Right. So if I'm playing a different game, I got to think differently, and I got to make sure that my thoughts are my own thoughts and they're for the game that I'm playing. We're playing a long-term game.
yeah,
We can reduce our risk exponentially just by making sure that when we invest our money, we invest it on the appropriate time horizon. I would never put money in the market that I need to spend tomorrow,
right,
like actually tomorrow.
yeah,
Usually, kind of in my own personal finances, I really don't put money in the market unless I'm gonna like need it beyond 2 years at a minimum,
Yeah.
you know?
I'm usually around 5.
Yeah.
Is what I try and do.
Yeah.
We another stat that we use is in you can use 4 or 5 depending on which time period you're looking at, but in any 4-year given period of time, you're going to have 3 up years and 1 down
Yeah.
year. And in case people don't know, that's 25% chance of actually losing money, and that's a lot. I mean,
Yeah.
that represents risk in the market. So that's why we emphasize things like emergency funds. If you're gonna buy a house in 3 to 4 years, don't put it in the market.
Which leads us to the next point,
yeah,
which is education. Educate. You got to be educated. So if you're listening to this podcast, great first step.
right,
But again, going back to that earlier intro, email us. Get inside of our ecosystem because we offer monthly webinars. And
Yep.
these monthly webinars are free, and they're a different type of education. So here we're talking about a lot of the emotional kind of piece, which is like 90% of the game.
yeah,
On the other side of this, we're giving the actual education on kind of the science of finance,
yeah,
which is about probably 9% of the game.
yeah,
And then the other 1% is just actually getting it done. And you can do it on your own, or you can hire someone like me to do it, get the task completed. That's opening the account or funding the whatever. So get inside of our ecosystems. But one of our webinars that you have access to, if you're in the email or in our ecosystem, you can log in and you can view the recording. But one of those is, I call it the path, and kind of borrowed that little idea from Jocko Willink. He's got his own path for a lot of what he does, and he has a book out there talking about creating your own path and following it. And the cool thing about a path is I know when I'm on it because there's trees all around me, and I'm not hitting trees every 2 steps when I walk. But the great thing also, I know when I'm on it, but I also know when I start to wander off of it. So if we have a path, and that path gives me certain steps and certain orders to take to make sure I'm making my financial progression in the safest way possible.
Yeah.
One of the things on the path, kind of what you were just saying, is get your emergency savings taken care of before you start putting money in the market.
yeah,
Right? So educate, get inside of our ecosystem, and plug into those webinars. That's a huge piece of this. The next thing is risk management.
Yeah.
And I'm going to, again, this is all about shameless plugs because we have all the tools, guys. We have the tools. If you will dive in a little bit, just trust us a little bit. We're not here to bug you, bother you, or twist your arm for anything. These are resources you can use and leverage Harpeth Wealth Partners. But on the risk management side, go to harpethwealthpartners.com, scroll most of the way down that landing page, and there's a little tool. You can watch a short video on it, but it's called Riskalyze. And inside the Riskalyze tool, you can find out what your risk number is. And if you already have a portfolio, we can input that portfolio into Riskalyze, and it'll tell you what your risk exposure is. So it's it's all based on speed limits, right?
Yeah.
So if my risk is, it should be 65 miles an hour,
yeah,
and my portfolio is doing 40, I understand why I'm frustrated and not seeing the returns that I think that I should see.
right,
And my advisor could know to up my risk and strive for potentially higher returns. On the flip side, I've seen clients think, hey, I'm 35 mile an hour driver, but my portfolio is driving 90.
yeah,
Right. So Riskalyze, that's on harpethwealthpartners.com. Number 4, for again, going back to, kind of how can I avoid behavioral mistakes? We've talked about long-term perspective, be educated and seek education, understand your risk tolerance and risk allocations. Number 4 here is regular monitoring.
yeah,
Regular monitoring and regular rebalancing. When we talk about rebalancing, that's a pretty good piece of the science side of things.
yeah,
And when we say regular, that's really dependent on your strategy. So we're not going to get too deep into that because that's kind of personal. Some people rebalance you know, monthly, some people quarterly, some people annually, and none of it's wrong. None of it's right per se. Like it's not wrong.
Right.
It's just all about the strategy. And so because it's so personal, just understand regularly rebalancing just implies that I have a strategy and then I'm employing and following the plan.
Yeah, I was going to say more importantly is just checking back in with where you're at on your path
Yeah.
and your strategy and everything. We take care of the rebalancing and everything else. That's what we do. So don't worry too much about that.
Sure.
But just the key takeaway there is to regularly come back and check in with your goals and see where you're at. Because
But I think if you're doing that on your own, like if you're truly managing your own portfolio,
yeah,
if you're listening and you're like, oh, I've been wondering how often I should rebalance, like that really depends on the type of portfolio. So it's more of a one-on-one conversation.
Sure.
Or you doing going back to that educate, like seeking out the right education. But understand, I don't necessarily think there's per se a right or wrong answer to how often. The most right answer is regularly, and regularly depends on the strategy.
Right.
But I will say, again, to plug our own app for financial planning,
Yeah.
our app monitors your progress on a monthly basis with quarterly reports. And so you can, what I love about this app is my clients get almost immediate feedback when we employ a strategy, when we talk about a next step, and they can see the impact it's having to their net worth, their cash flows, their financial vital signs, their scorecard. Like it's immediate feedback. We don't have to wait until next year to see how things are going.
Yeah.
It's next month.
Yeah, one of the things I love about the app too is something that I'm always working with my clients on. And when people ask me, Bill, how can I, what's a little trick that I can do to kind of get a leg up with my finances? One of the things I'm always saying is treat yourself like a business. Look at yourself as Bill Incorporated. And, Bill Incorporated makes X amount of money per year. His expenses are this, his liabilities are this, his debts are this, his savings are this. Go through a budget and a net worth sheet, but that's what the app does. And so when you take that step back and look at yourself as a business, that does a couple of things. It takes the emotion out of seeing whatever numbers are in your bank account and making all your decisions based on that. You're actually taking that 10,000 foot view to look at yourself and how you're operating. And that app is just a resource that does exactly that with you, for you, makes it super easy. And it's clean. Typically it's that 1-page quarterly report that shows you where you're at. I mean, it's very simple, but it's extremely valuable.
I love it.
Yeah.
I use it.
Yeah.
And I love it. So we'll wrap up. I think, the last step that I have is seek professional advice, feedback. Guys, you should seek out financial people that you trust that are willing to kind of meet you where you're at. Not everybody needs to pay, a percent of AUM. Not everybody needs to pay for, super expensive $10,000 financial plans. Sometimes you just need a couple hours of time to say, hey, does this make sense? Is there anything that I'm missing? Can you help? And, oftentimes true financial professionals will find a way to say, hey, yeah, I can totally help you. It'll cost you a couple $100, but I'll definitely give you my red ink on what your plan is already and hope that you get to a point where you're uber successful. And then you do trust me to take on more of a role in your financial, success and journey. So guys, like, don't think if you know some financial professionals, financial advisors that are just like, yeah, I'll take your money and you need, $200,000 to work with me and I'm gonna charge you 1% and all this stuff. There are definitely financial providers out there, professionals that will just say, hey, show me your questions. Here's an invoice for, a couple $100 and let's figure it out. So seek out that help if you have questions or if you can't find the answers or if you don't feel confident. And I'll just leave you with this little thought, turn it over to you to unleash us and send us on our way. But, at the end of the day, your behavior trumps your portfolio 1,000%. If you can have the world's best portfolio, you can have the perfect investments and it's well balanced and diversified, But at the end of the day, if you can't control your behaviors and you get greedy when everyone else is greedy, or you get afraid when everybody else is afraid, and you don't have those checks and balances, that OODA loop that we've talked about before, if you don't have those things to go to and say, hey, I think I'm about to make a mistake, run down a checklist. If you don't have that, you're probably going to make a mistake. And some of these mistakes are like incredibly devastating. The only people that I have met that are truly in financially terrible positions are the people that got hurt in 2008. And the common thread of every single person that I personally have met in 2000 that was hurt, derailed by the 2008 financial crisis, are people that sold well after things got real bad.
Right.
And they didn't just weather the storm.
Yeah.
And some of them, unfortunately, were taking advice from professional people that gave them horrible advice.
Yeah.
But that's the people that I personally, your story could be very different, but the people that I met, those people that were derailed, that lost everything, was because they sold out of necessity or because they got scared. It doesn't matter. They sold when things were bad.
Right.
So that's it. What do you got?
Get somebody in your corner that you trust.
I like it. All right, guys. That's all we got for you. See you next week.
Adios.
We hope you learned something valuable today. We appreciate you including us in your journey towards financial betterment. It is important to us that you know this is for educational purposes only and not to be considered specific advice for any individual listener. If something we discussed is relevant to you and you have questions about how it might be uniquely applicable to you, please discuss that with a financial professional, or, of course, we are happy to have further conversations with you about your specific questions, needs, or circumstances. We welcome you to reach out to us via our website, harpethwealthpartners.com, or by emailing Brandon at bmc@harpethwealthpartners.com. Securities are offered through LPL Financial, member FINRA SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Harpeth Wealth Partners are separate entities from LPL Financial. The opinions voiced in this material are for general information only and are not to be intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult appropriate qualified professionals prior to making a decision. Investing includes risk, including fluctuating prices and loss of principal. No strategy assures success or protects against loss. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Hypothetical examples presented are not representative of any specific investments. Your results may vary. We want to thank you for your time, and we look forward to having you back next week.